While inflation has cooled from its recent highs, it still remains a key focus for policymakers and households alike. This week, we're giving you an update from the Federal Reserve's March meeting to unpack what the latest signals could mean for prices, paychecks, and the path ahead. To tell us more, we're joined by JPMorgan Private Bank's Global Head of Macro and Fixed Income Strategy, Alex Wolf. Welcome.
Thanks for having me.
Alex, what did the Fed say about inflation, and how does that guide when and how quickly they might start cutting interest rates?
They're balancing a very difficult dual mandate. So they're thinking about inflation and their inflation target, as well as the labor market. And now, prior to this recent oil price spike and the conflict in the Middle East, inflation was trending downwards, and it looked like they were moving towards an eventual cut, which was our view for this year. Now, with oil prices moving higher, it creates the risk of what's called stagflation, where you have higher inflation and weaker growth, and it makes their job far more difficult. Now, they said they intend to still cut, but the timing of that is now uncertain. They'll likely have to wait and see, A, what happens with the conflict and how that impacts oil prices and how that feeds through to the economy, and then at what point they can then move to cut rates. So they'll likely wait for inflation and oil prices to plateau, to stabilize, and then as it begins to fall, perhaps later in the year, it can give them room to cut.
And when it comes to consumers, which everyday costs are going up the fastest, and what would it take for those increases to slow?
You really have two things. First, we had goods, everyday consumer goods that were tariffed last year. Prices of those goods went up because of tariffs. We think that's likely subsiding, but they're still higher than where they were at the start of last year. However, what's most pressing right now is the impact of higher oil prices and how that feeds through into broader consumer goods. Oil prices have really spiked recently. That filters through into broad fuel, broad input prices, and then that eventually starts to hit more of a broad set of consumer prices.
So, diving deeper into rising oil prices, what's causing their increase? When can consumers expect some relief? And how could this possibly impact other parts of the economy?
So the first one is easy in that we have reduced supply of oil on global markets. The Strait of Hormuz, where oil from the Persian Gulf passes through, the physical shipment passes through, is effectively closed. That is reducing the overall global supply of oil and pushing up prices. Second question, in terms of when consumers can expect relief, that's impossible to say. Unfortunately, it really will depend on the path of the conflict, whether we see a resolution in the near term or whether this goes on for longer. As long as the conflict is ongoing and that Strait of Hormuz remains closed, it does dramatically restrict oil and it keeps prices elevated. So the outcome of the conflict, how long the strait remains closed, that is really the key factor, and it's become very, very difficult or nearly impossible to predict. How it's impacting the economy, it's having an impact on the global economy, perhaps more so on the rest of the world than the US, given that the US is an oil producer. So it imports far less than it used to. Asia, probably the most impacted. It imports the vast majority of its oil through that strait from the Middle East. It also is a very large importer compared to the US. So higher fuel costs have a much more acute and direct impact on the economies, particularly of East Asia. So it's going to feed through to higher fuel costs, lower disposable income, weaker growth, higher inflation.
How is the labor market interacting with inflation right now?
So right now, we're not yet seeing an impact. The labor market is what's called a lagging indicator. You don't see it react right away. So in a few months, we could see the effect of higher uncertainty. We could see the effect of higher fuel costs on firm behavior. And that said, coming into this crisis, we've already had a fairly weak labor market. Hiring has been weak now for a number of months. You could even go back roughly a year, it's been weakening. And it's a type of an economy that we say is a no hire, no fire dynamic, this very unsteady equilibrium where firms are just not really adding jobs. They're not laying off workers, so we haven't seen unemployment rise, but just fairly weak in terms of new job creation, which is what you want to see. And so the risk really is that we see this uncertainty from the crisis and from geopolitical risk. We see higher fuel and higher input costs, and that feeds through into further weakening the economy. But of course, we haven't seen anything yet, so it's still kind of a wait and see mode.
Lastly, where can people go to learn more about your team's insights?
We do put out a lot of publications, and we publish our thoughts on whether it's current events or views on the market. And so to read that and to learn more, can go to jpmorgan.com/private bank.
Alex Wolf, thank you so much for being here today.
Thanks for having me.